Let's get into private capital, private credit now, reasons why potentially you love an allocation. Patrick William from Rixon Capital joining me. We're talking so much, Patrick, about Division 296, the cap, yes. The tax rather here on unrealised gains. Why then would you potentially look into private markets, into private credit, potentially to get away from that?
Yeah, so the two elements to it. The first and the most obvious one is if you've got a portfolio and you're above the $3 million cap and the legislation comes in, you've got to turn up with the cash when these unrealised capital gain liabilities emerge. So an allocation to a high cash yielding private credit strategy actually generates that cash flow which you can use.
So you can use it into private credit, and as you say, this is just more reasons why people are loving allocation at the moment. What have you seen in terms of demand since we last spoke?
Continues to be very strong. So there's a little wobble 2 or 3 months ago when people started to switch back into equities. We're seeing that switch back in favour of private credit. When you consider the factors, if you look at the ASX 200, the long-term return's 10%. The ASX 200 at the moment is trading at 20 times forward PE, which is 30% above the 15 times PE, which is a long-term number. So that's just ripe for a correction. On the flip side, you can get 10 to 12% cash paid in private credit, which becomes a no-brainer, particularly for a retirement portfolio.
So you're saying the rising equity risk is a potential reason here?
Absolutely.
What are you seeing as well in terms of when you select a private credit strategy? What should people be looking out for?
Yeah, it's very important these days given there's been negative press again because of a handful of bad actors in the space. And I tell investors to go down to first principles, 3 things to look out for, and it'll keep you very safe. Number 1, make sure they've got an AFSL. You wouldn't see a GP that was unregistered. You should apply the same logic to your manager. Second, ensure they've got a third-party trustee, a regulated licensed entity that holds your cash and holds the assets. That stops the investment manager from going rogue and buying a Lamborghini with your money. And thirdly, make sure you've actually got visibility around the portfolio and you understand how that return's being generated. Because if it's a black box, there's a chance you'll find out on the front page of the AFR one day, and that's not what you want.
I mean, Australia's a pretty regulated space. Is it really that common that people are going to unregistered advisors?
It is extraordinary. I
Really?
mean, you jumped, like my kid's on Instagram, so I'm on Instagram.
Yeah.
There are funds that advertise on Instagram, and you click on it. As a fund manager, I go straight to the bottom of the page, no AFSL, but the headline returns are so attractive. It works, unfortunately.
Is that just a red flag in itself? Don't get your financial advice from social media?
Yeah, if you see it on Facebook, it's probably not the place you should be putting money, yeah.
Yeah, okay, and you've been travelling a lot, Patrick, so tell us what you've been doing and I guess what you're seeing in the space. You talked about demand still being very strong.
Yeah, so you're spending a bit of time in WA and Melbourne. The feedback from investors there is a gradual shift in education from being property obsessed. You know, there used to be a lot of property private credit, there still is, but sophisticated investors are becoming a lot more selective in that space because they've realized there's a difference between a 50% LVR on a brownfields shopping center with tenants and a 50% LVR on a residential subdivision. So what we're finding is investors are becoming more discerning on that risk reward profile, and we're taking capital from the subdivision market because people have realized that is higher risk than they're comfortable with.
Outside of property though, what sort of major allocations are you seeing?
Well, a lot of lending to lenders, so that's really our bread and butter. Yeah. So the lending market, particularly in a weaker economy, more people go into credit. So well-structured consumer finance, even a B2B finance product can do very well. And what we're seeing is, like you just reported, the big boys are doing very well and there are lots of new entrants coming in, picking up niches, running very well, and they need a debt product.